Welcome back to Business Week on Arise News. I'm joined now by Efosa Aluyi, Head of Investments at Sankore Global Investments, to help us review some of our top stories in more detail. Welcome to the show, Efosa. Great to have you.
Thanks for having me.
Yeah, so I wanted us to start with China. A lot has been happening in China. Liquidity injection, lowering of interest rates. The government seems a bit desperate.
Yeah, I mean, so China seems to have hit some kind of post-pandemic growth slump, if you will. And we characterize it to think that this is some sort of maturity with the Chinese economy. And if you look at what's happening with China's economy right now, it draws very strong, similarities with what we had in Japan in the late 80s when, Japan was growing really, really strongly. Matter of fact, was started to take over from the US at the time. And then property prices really went through the roof. They had a property burst and then went into a deflationary spiral that lasted over 2 decades. China is showing signs of almost going that path, if you will. I mean, growth in China since 1978 has averaged about 9%. However, if you look at the sort of growth that we've seen post-pandemic, it has slowed down. So in 2020, for instance, growth was about 2.9%, right? But however, we saw a post-pandemic bounce in 2021 where GDP went up by about 8% or about. But after that, we saw 2022 growth slow to just under 3%, while growth last year was 5.22%. So what the Chinese government has done is to set a growth target of 5% for this year. However, the slew of data that we have seen in the recent past is clearly reflective of the fact that they are unlikely to attain that 5% target. So you've seen retail sales, you've seen industrial production, even trade data seems to be significantly challenged as well. A number of issues, right? So right now, China is also dealing with a deflationary challenge, right? It is essentially trying to ward off its longest streak of falling prices since 1999. The latest inflation figure we had for August was 0.6%. If you compare that to the inflation figure we had last year, it was 2.8%, right? So this again is reflective of the fact that demand is weakening, the consumer is sort of weaker, and that is having an impact on overall aggregate demand in the economy. And then another key issue, again, you want to look at is the property situation in China. I mean, that sector and all of its ancillary services account for anywhere around 1/3 of that economy. It's been bogged down for the last 3 years. A lot has been done to try to sort of revive it, but nothing has really worked the way that the Chinese authorities really do expect. So this move that we're seeing now is a bold one. It's essentially almost, throwing in the kitchen sink to say, look, we need to save this economy from this further spiral that we're seeing. So a lot of the moves are largely monetary. So you're seeing the reserve ratio for the banks being dropped about 50 basis points. That is expected to free up about $1 trillion yuan to boost lending. You're also seeing the 7-day repo, the medium-term repo, all of those rates have been dropped. Also, the rates on, existing mortgages have been dropped by 50 basis points. Now,
so if I may ask you, you said quite a lot in there, and I'm wondering the growth model for China itself, before we sort of look at the dynamics of the various liquidity injections, it seems to me like there needs to be a fundamental shift in the economic structure and model of China in terms of growing its economy. What should that shift look like?
And that's what they've been trying to attain over the last couple of years, right? That model has been an investment-led one.
Yes.
They're trying to make a pivot to a consumption-led one. It really hasn't worked. So for instance, I mean, consumer spending accounts for just around 40% of Chinese GDP. That's about 20% lower than the global average. In a place like the US, about 70%. In Europe, it's much higher. So all of the measures that they've been taking over the last couple of years is to try and pivot that economy to a consumption-led one. Investment is still the major thing that drives growth in that economy. And what investment does really is to also then create a lot of debts, right?
Absolutely.
And a lot of the local governments are laden with a lot of debt right now. As a matter of fact, that debt is estimated anywhere around $13 trillion. And it continues to grow because that pivot really hasn't happened. Like I highlighted earlier, the consumer appears weak. That demand is not really there. And that's why you're seeing inflation really slow down. And there are concerns about a deflationary concern in China. So these are the issues. The inability of the Chinese authorities to really pivot that economy away from an investment-led one to a consumption-led one really is at the bane of all of these issues.
And I guess that would then inform the decision to give the banks a break by injecting liquidity, lowering rates, because that will translate to lowering borrowing costs for businesses and consumers' borrowing costs. But do you see that translation effect having an impact in the near term to help sort of boost consumption?
I mean, what we've seen really, and what we see a lot of times with monetary injection is that you're seeing financial assets really do very well, right?
Yeah, sure.
So you've seen the Shanghai Composite is up about 12% in less than a week. The Shenzhen is up about 17%. Matter of fact, both indices are on course to post their strongest week since 2008, right? So we're going to see that flow into financial markets. However, for the consumer, it really remains to be seen. Estimates are that we could see these measures add maybe about 40 basis points to output growth. However, the thought again is that it's coming sort of late towards the end of the year, because at the end of the day, what they are trying to do is to attain that 5% target, really. But with these measures,
a tall order.
It looks really tall at this point.
Interesting. And, of course, we often watch China to sort of gauge global demand as a whole, especially where commodities are concerned. So it'd be interesting to see how that impacts commodities. But let's move on from China to Kenya. Kenya is courting the Emirates, Abu Dhabi specifically, for $1.5 billion, I think, dollars. At 8.2%, which I think in this market is pretty good. What do you make of this reaching out to Abu Dhabi?
I mean, it's probably desperate measures, right? I mean, this is coming on the heels of the fact that, the tax hike that had been planned in June, which was going to raise about $2.7 billion. It didn't quite work. It was dogged with a lot of protest, and that didn't work. And then obviously, Kenya tried to look at the IMF. There was a lot of delay there, and that continued to exacerbate the problem. So clearly, they've been struggling to look for financing or funding sources since that happened. And this, for them, is a welcome development. Like you said, 8.2%. The tenor really, isn't clear. But what has happened over the last couple of months is that relations between Kenya and Dubai or Abu Dhabi, they've improved quite significantly. So hence this sort of arrangement that we're seeing. And if you look at what has happened with Kenya now, what this is going to do is to further aggravate the fiscal deficit situation that you've got in Kenya. The tax plan. So if the tax plan had gone ahead, fiscal deficit would have sat somewhere around 3.3% of GDP. But with this loan now, it's going to go to about 4.3% of GDP. So that's going to be obviously concerning for Kenya. As a matter of fact, earlier on in the year, they raised some money at about 10.375% 7-year Euro bond, which was quite expensive. So right now, Kenya is really looking for any way it can get funding to plug those fiscal holes. And they're not alone, really.
Particularly cheaper funding.
Absolutely.
So, I mean, they did the Eurobond. They've now gone to Abu Dhabi. What other options does a country like Kenya in sub-Saharan Africa have now in terms of getting long-term funding at a relatively decent pricing?
I think these sort of counterpart funding are probably the best options right now, where you have countries who are awash with these dollars and you've got good relations with them. I think it is something to really explore, because the conditions can be fair, they can be renegotiated. They are certainly not as punishing as the international capital market, where if you miss a payment, for instance, it has implications for how you're going to come back to raise money, and has implications for your ratings and all of that. So I think it's a good one, for Kenya. I mean, it's been a long time coming, really, the fiscal situation in Kenya. These are moves that hopefully puts them on the right path going forward.
Indeed, and I imagine there'll probably be some investment incentives for Abu Dhabi in the Kenyan economy as well out of this. Okay, let's move on to Nigeria now. The MPC decision, which happened during the week. I think for a lot of people who are observers of the market, many people I know in my ecosystem called a hold. So some people were surprised that we went with this hike. But if you look at some of the inflation data, maybe not so surprising. What's your take on it?
I think quite a lot of people were surprised, given the sort of progress, albeit minimal, that we had seen on the inflation front, and the fact that we'd seen very aggressive monetary policy hikes. So the impression really was that the committee would sort of hold its horses and see how things pan out. But again, that sort of hike is symptomatic of the fact that the committee feels that there are inflationary pressures down the road. I mean, they cited the fact that core inflation was still very strong and still a huge concern. We've seen movements in petroleum fuel prices, and that should have implications. We're looking at tariffs on electricity as well. You're looking at the implementation of the minimum minimum wage as well. So there are inflationary, pressures that the committee is trying to ward off against by, sort of being proactive with this sort of hike. So, but generally, I think most of market participants truly were not expecting this hike.
Oh, really? Yeah. So, I mean, looking at this hike now, and given where the government's inflation target was, or the central bank's inflation targets was, we're entering into Q4. What do you think is the most likely outcome for the inflation outlook, given this hike? We've seen a slowdown in the last month or so.
I mean, again, if you look at the inflation phenomenon with Nigeria, a lot of it really has to come from that cost side of things. Monetary policy does have an impact, but to a certain extent, it really is unable to do much. Given the impact that we've seen from fuel prices over the last month or so, the potential that the minimum wage be implemented soon, there are clearly inflationary pressures that are on the horizon. This hike, whether it would do a lot to assuage or bring that down, really remains to be seen. But one thing is clear, certainly it's going to have an implication on the productive side of the economy.
Of course, yes, indeed. Thank you so much, Efosa Aluyi, for your awesome insights. As always, I've been talking to Efosa Aluyi, Head of Investments at Sanctuary Investments.